IPSAS 2, Cash Flow Statements, is a standard that provides guidelines for the preparation and presentation of cash flow statements by public sector entities. The primary objective of a cash flow statement is to provide information about the historical cash flows of the reporting entity. This information is useful for assessing the entity's ability to generate cash and cash equivalents, as well as its needs for liquidity. IPSAS 2 requires entities to classify cash flows into three categories: operating activities, investing activities, and financing activities. Operating activities include cash flows from the core operational activities of the entity, such as cash receipts from taxes, fees, and grants, as well as payments to suppliers, employees, and other operating expenses. Investing activities involve cash flows related to the acquisition and disposal of non-current assets, including property, plant, and equipment, as well as investments in other entities. Financing activities include cash flows from transactions with the entity's owners and creditors, such as issuing bonds, taking out loans, or paying dividends. IPSAS 2 allows entities to present their cash flow statements using either the direct method or the indirect method to report cash flows from operating activities. The direct method involves disclosing major categories of gross cash receipts and gross cash payments. The indirect method begins with net income and adjusts for non-cash items and changes in working capital. If the indirect method is used, IPSAS 2 requires entities to reconcile net cash flows from operating activities with the entity's net surplus or deficit for the reporting period. This reconciliation helps users understand the relationship between accrual accounting and cash flows. Transactions that do not involve cash or cash equivalents should be excluded from the cash flow statement. Instead, they are disclosed elsewhere in the financial statements. Cash flows denominated in foreign currencies should be translated into the entity's functional currency using the exchange rate at the date of the cash flow. Any resulting exchange differences should be disclosed. Bank overdrafts that are repayable on demand should be considered as cash equivalents when determining cash and cash equivalents in the cash flow statement. Cash and cash equivalents include cash on hand, demand deposits, and short-term, highly liquid investments with original maturities of 3 months or less. IPSAS 2 specifies detailed disclosure requirements related to cash flows, including information about the nature of cash equivalents, the components of cash and cash equivalents, and cash flows by category. Entities are required to ensure that their cash flow statements comply with all applicable IPSAS. If a conflict arises between IPSAS 2 and another IPSAS, the requirements of IPSAS 2 prevail. Cash flow statements prepared in accordance with IPSAS 2 provide valuable information to users of financial statements, including policymakers, investors, and creditors, to assess the entity's liquidity, solvency, and ability to meet its financial obligations.